Coming on the heels of geopolitical uncertainties, the December quarter earnings were keenly awaited by investors to gauge demand trends amid fears of a slowdown. However, what swayed Q3 earnings was neither significant degrowth in demand nor input costs, but finance cost. A business standard analysis shows that the combined interest expenses of 888 listed companies, excluding firms in the banking, financial services, and insurance space, rose nearly 31% year-on-year. This was the fastest pace of growth in at least 17 quarters. As a result, the combined net profit of these companies declined 13% YOY to 1.21 trillion rupees from around 1.4 trillion rupees a year ago.
The operating margins continue to remain stressed for most of the companies, except for IT and BFSI. Dent in operating margins have clearly seen, which has resulted in slow earnings growth. Also, hikes in interest rate has slowed down the demand as well as consumer spending and increased interest costs.
Including financials, net profit of over 1,600 companies listed on the BSE stood at 2.45 trillion rupees at the end of Q3 FY23. This is higher by around 5% on a yearly basis and 18% sequentially. Sales meanwhile rose 19% YOY and less than 3% quarter-on-quarter to 27.22 trillion rupees. As per Motilal Oswal Financial Services, 29 companies saw upgrades while 41 companies saw downgrades of more than 3% each. This has resulted in an adverse upgrade to downgrade ratio for FY24. Given this, Nitin Bhasin of Ambit Institutional Equities believes the earnings deceleration can be reversed if India sees more jobs in the rural economy.
I think it's largely the banks which are the best performing sector in the entire quarter. Consumption, mostly in rural as well as in the discretionary, is suffering. There were some inflationary advantages of the commodity prices coming down for most of the companies or sectors which held the margins, but otherwise revenue growth was a little tepid. Unless and until job creation and the rural economy does not recover materially, we can't see a material change in the trajectory to the earnings deceleration which we are witnessing.
He says this will hinge on inflation trajectory and sustainability of domestic demand.
There isn't much of an improvement in the rural economy. Continued pressure emerging in the urban consumption, in the discretionary, and perhaps that is also visible in the decelerating or not much increase in the residential real estate. These are the three things that one needs to watch out for over the next 2 or 3 quarters. Whilst we see that inflation pressures have receded, one needs to be watchful about how the inflation perhaps in a few products such as metals, etc., comes back and impacts the margins. But for right now, it isn't the input cost that's a pressure. But moreover, as the bank's cost of funding rises, that could be the other thing to watch out for. A healthy sector which has been posting some very good numbers.
Solanki of Anand Rathi further adds that high interest rates could delay private capex, delaying capacity additions and thus affecting the production capacity of India Inc. This week, retail and wholesale inflation data for India and the US, along with other global cues and stock-specific action will guide the markets.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.